to EverGuide Financial's educational video on cash flow statement analysis. We're going to dive right into things again today, similar to like we did with the balance sheet. If you have any questions about how we downloaded this information and got it into Excel, please refer to the income statement video, and that will go through and demonstrate how we did this. So to start off today, as we go through the cash flow statement, one of the things that we added, which is a little bit different than previous videos, was this line item right here, which is total revenue. So we took this number from the income statement in order to do the common size cash flow statement. And the reason for that is, again, there's a lot of numbers within the income statement, the balance sheet, the cash flow statement, and it's always good to take a look at it and see how things have, when you put a percentage and a common size on it, it makes it a little bit easier to read and interpret the data. So what we did here, just very simply, is you're just taking the net income number and dividing it by revenue, and this gives you 14.85% of net income to revenue. And so, in this case, it's a net profit margin, another way to say it for here, but we applied this across all the different metrics of the cash flow statement. So before I get into a little bit more of this, one of the things I want to talk about is, why is the cash flow so important? And one of the things, whether it's the balance sheet or the income statement, there's a lot of accounting assumptions that are built in to financial statements. One of the things that cash flow does is it takes out some of those assumptions, and it actually adds back these non-cash charges. So sometimes you get charges to net income, but you're not actually paying anything out of pocket. So you still have that cash, and that's why cash is a very, very important thing to look at. So before we get in and go through this step by step, the cash flow statement is really broken out into three pieces. The first part, which is cash flow from operating activities. This is, in general, everything, all the cash that comes in and out of the company through your general operations. So this is IBM, and so anything that IBM does, all the cash that they generate through their day-to-day business, this would be reflected in operating activities. The next section, as we go down here, is from investing activities. So every company, even though they're operating and doing something within the business, sometimes they're doing things to invest in that company, either by selling off pieces of the business, buying other businesses, investing in plant and equipment, things like that, and that would come under this area. And the last part, which is cash from financing activities. So this would be anything from that has to do with how you finance your business. So that would be an issuing or retiring of debt, or issuing or retiring of stock. That's really what it comes down to. And then obviously, and a very, very important part, which is any dividends that are paid. And then once you go through all this, at the end of the day, you get a net cash position. So how did the cash change for your business over the course of the year once you take all of the different pieces of cash flow into perspective? So that's the quick overview, and now I'm going to go through and walk through each one of these line by line. So the net cash from operating activities, which is down here, basically you're going to take, it starts with net income, and then you add back certain parts of the accounting that are non-cash charges. So for instance, right here, when you talk about depreciation, depreciation is when you invest and you build property or plant or equipment, or if you own a home, or if it's in real estate, then that you have to take these charges because these things wear down over time. So rather than take the charge all at once, you spread that out over a number of years, and you know that eventually you're going to have to replace that. So even though you have depreciation of $3.6 billion here, which is this number, there you didn't actually spend $3.6 billion. So that's why you add it back. And so that's one part, and that's usually going to be a big part of this, which you can actually see when you look at it on common size, 3.6%. It's pretty consistent from 2010 all the way to 2019. There was actually a slight jump up, from in the mid threes to high fives. So again, as we talked about in the other ones, that's something you may want to look at. We may want to look at and say, okay, what happened? Why is depreciation so much higher in this particular year? And then, again, we can just start here with net income as well. You can see, so 14, 16, 12, 16, 14, 7, 10. So it was fairly consistent for a period of years, dropped in 2017. Net income was really low. And then it started to come back towards its previous of 14 to 16%. So that's something to look at. Another part too is you can see it's 9.4 billion of revenue, or I'm sorry, of net income in 2019. Going back to 2010, it's 14.8 billion. So obviously they've had some struggles in generating profits over the last 10 years. So again, it's something to look at. As we go through here, I'm not going to walk through every single one of these because you're making small adjustments. I mean, even here you look at inventories. It's a very, very small number, so we're not going to pay too much attention to it. But you get here, and we'll get to the final number, which is the cash flows from operations. And actually, again, and this is why this is important to look at. So your net income figure has dropped from 14% to 12% over the last 10 years. And net income has dropped pretty consistently. But what's interesting, if you look at the cash flow on a sales basis, so common size, so cash flow divided by sales, it's actually gone from 19% to it was very successful in 2015, 16, and 17, over 21%, and it's now back to 19%. So they actually generate a lot more cash than what you would expect. So that's actually, again, for somebody that's looking at this, that's somewhat encouraging when you say, okay, the revenue hasn't been great, net income is down, but they do generate a lot of cash. So that's one thing to look at. So now we'll go into the this section here, which is the cash flow from investing. So this part here is just again, property, plant, and equipment, and you can see they really spend about the same amount every single year. It's right around 4%. It actually dropped down quite a bit in 2019, down to 2.96, but on the previous years, about 4% is what they spend. Then the next here, so you can see, this one is investment in software. They're not spending too much investing in their software, a little less than 1% of sales. One of the other things here, this is just marketable securities, so we're not going to go through that too much. But here, which is interesting, so this is an acquisition of businesses. So this is important to look at because you get to understand the strategy or the business strategy of a company at that period of time. Are they generating business internally from everything that they already have, or are they going out and purchasing businesses? So you can see it had been they do spend money on acquisition of businesses going back to 2010, and it's relatively 5.9%, 1.6, 3, less than 1%, 4.7. So they spend a little bit. What's interesting here is 42% in 2019. That's obviously a big number that sticks out. If you didn't know anything about the company, you'd want to say, well, let me go take a look and see what that acquisition was. I just so happen to know that this was a purchase of a company called Red Hat, and this was a big acquisition for them. So it's going to change because of the size of that acquisition. It's going to change the overall look of that company. So you're going to want to spend a lot of time looking at what that acquisition is going to do for IBM overall. And then divestitures, this is something that, again, you would want to look at. Sometimes companies divest businesses and they say, it's not part of what we're doing overall, so we're going to sell that and do some things to either clean up the balance sheet like we talked about last time, or find ways to generate some additional cash to fund the business. They haven't done a lot of it. Looks like there was some, about 2.5% at this point in time. 1.3% last year. This was probably something done to make sure that they could get the Red Hat acquisition through. And then again, here you look and see from investing, almost all the time there's going to be some type of investment, so there's going to be a reduction in cash. And obviously the big one here again is from that acquisition of a business of Red Hat. Then the last part here, which is the financing. And again, this is from, how are they financing their business? So one of the things to look at is proceeds from new debt. So if they issue new debt, how much are they issuing any particular year? And that adds to cash, because you're borrowing money, you're adding cash, and then you eventually have to pay that back. And so they're fairly consistent. They issued a little bit of debt here, but more importantly, you go again 41% in 2019. It was almost 32 billion, which will go back to the acquisition of a business. Almost 32 billion. So they financed almost that entire purchase through new debt. Again, I'm not saying that's good or bad, but it just tells you something about the business. And you better hope, or IBM better hope, that what they paid for this business is going to generate returns for them in the future. Here, payments to settle debt. This is, a company is always going to have debt mature. So if you're paying off debt, then that's cash that's coming out. So you can see there's actually, if you net it out the two, it's how much debt did they actually raise for the year. So it's something to look at. These are just short-term borrowings. Usually that's pretty small. This part here is common stock repurchases. So one of the ways that companies can generate return for shareholders is by buying back stock. So if they have cash, which we noticed before, they produce a lot of cash flow, even though their businesses, the revenues and profits are dropping, they still generate a lot of cash. So what companies will do is, if they think if their stock is undervalued, they can buy back those shares. And why does that make sense? Well, if the price per share, so if it's trading at $100, then if you have less shares out there and you have the same profits, then the price per share should go up. And so it's just one of the things where they're buying back shares. It's another way to return money to shareholders. So you can see back in 2010, 11, 12, 13, 2014, for several years, they bought back a lot of shares. They used a lot of cash to buy back shares. And then they really dropped down. They don't really buy back that many shares anymore over the last several years. It goes to show you, okay, well, maybe their business is doing as well, which we noticed from net income. So instead of spending that money to buy back shares, what else do they do? And here's the dividends. So you can see they've actually increased their dividend almost every year over the last 10, even though the business isn't doing well. So in order to fund that from cash, they had to reduce, again, their share repurchases. So it's just one thing to look at, and it allows you to see kind of where they're spending that money. And then, so here's your net change from financing, which interestingly enough, because of the new issuance that they did for that purchase, their financing, they actually increased cash by $9 billion in 2019. And then once you do that, there's a small change for exchange rates because it's an international business. And then you get to the last part here, which is the actual change in cash over the course of the year. And you can see, it was negative, positive, negative, positive. There's no real trend here. This was a good year in 2017, and then this was lower, and that included a pretty big transaction. So That's pretty much it for what we have today on the cash flow statement. And again, it just goes back to looking at it from a common size and walking through the different line items to see what's going on with the actual business.